So looking at Robinhood markets right now, ticker HHOOD, as of today, April 20th, 2026,
Right.
are we looking at a radically undervalued strong buy that's, riding massive crypto tailwinds? Or is this a highly volatile value trap that's just flashing completely mixed signals?
That is the multi-billion-dollar question right there.
It really is. So welcome to the deep dive. Our mission today is to just sift through all of it. We're talking the latest financial reports, technical charts, market sentiment, and the analyst readings.
Basically trying to figure out exactly what is happening with Robinhood stock.
Exactly. And real quick before we get into the weeds, I have to state explicitly that this deep dive is for educational purposes only. We are having a natural human debate on the numbers today. This is not financial advice.
Definitely not.
And since we're doing the legwork, please make sure to like the video, subscribe to the YouTube channel, and I'm making it compulsory today. You have to leave your feedback in the comments. We want to know what you think.
For sure. So just to establish our baseline context right now.
Yeah, lay it out for us.
So Hood is currently trading at $90.75,
Okay.
which is showing a daily uptick of about 4.49%.
Hmm.
And we're really in this high volatility phase right now.
Because it's recovering from that year-to-date decline, right?
Exactly. It's recovering, but it's also actively testing some really significant long-term resistance levels.
Right. So transitioning from the daily price action to the actual, the fundamental engine driving it, does the 2025 performance actually justify where the price is at right now?
Well, let's look at the raw data.
Mm.
Full year 2025 revenue hit $4.50 billion.
Wow.
Yeah, and Q4 alone brought in $1.28 billion of that. Net income was $1.8 billion,
That is a massive chunk of profit.
with Q4 contributing $605 million. And diluted EPS, so earnings per share, sits at $2.05.
Okay, with Q4 EPS being what, around 66 cents?
Exactly. But the standout metric here is the margin. Their net profit margin is a staggering 42.10%.
Which is wild for a brokerage.
It's totally wild. And looking at the balance sheet, they have total assets of $38.14 billion against total liabilities of $28.99 billion.
So that leaves them with, what, 9.15 billion in equity,
Right, which gives us a debt-to-equity ratio of 1.71.
which isn't terrible for a financial institution.
No, it's pretty standard given how much capital they have to float. But cash flow is where things get a bit extreme.
Oh, yeah. I saw this.
So their free cash flow margin is super healthy overall, 35.4% for the year. But Q4 showed massive volatility. They had a negative $1.111 billion in free cash flow.
Negative $1 billion in a single quarter.
Yeah, it's extreme. And the 52-week range reflects that kind of whiplash. The stock swung from a low of $39.21 all the way to a high of $153.86.
Okay, let's unpack this because I'm looking at their PE ratio, the price to earnings, and it's currently sitting at 44.28. To me, buying Robinhood at a 44 PE, it's like buying a high-performance sports car, right?
How do you mean?
Well, it looks great. It goes incredibly fast with those 42% margins. But a 44 multiplier is just steep maintenance compared to, traditional brokers who trade in the teens. So I have to ask you, is this truly an undervalued stock with a fair value of like 120 to 135? Or is this a classic value trap where retail traders are just about to get caught holding the bag?
What's fascinating here is the total tug of war going on in the valuation right now.
The contradiction.
Yes, there is a glaring contradiction.
Yeah.
If you look at recent filings, Robinhood executives are actively selling their own personal shares.
Which is never a great look.
Right, insider selling usually causes panic. But at the exact same time, institutional ownership, the big Wall Street players, remains massive. It's sitting at roughly 93%.
Wait, 93% of the float is owned by institutions?
Exactly. So the smart money is essentially holding the bag, but they're holding it very tightly. The risk is that these high multiples can trap retail traders who just buy on momentum and hype, rather than looking at the fundamental equity.
Right. Well, if institutions own 93%, let's pivot and look at what the charts and the volume are actually telling us about where that smart money is moving today.
So technically speaking, the short-term trend is positive, and the medium term is shifting from neutral to improving.
Because it just broke through that channel, right?
Exactly. It just broke upward through a medium-term falling trend channel, which is a major bullish signal for algorithmic traders.
Okay, so what about the momentum indicators? because the 14-day RSI is currently at 69.23,
Right, which means it's rapidly approaching overbought territory.
meaning the buying pressure is super strong but might be getting exhausted.
Exactly. It's sprinting, but it might need to catch its breath. And then you have the MCD, which is at 3.78.
And that's flashing a positive buy signal.
Very strong buy signal. The short-term momentum is aggressively crossing over the long term.
Okay, so where are the safety nets? Where are the key levels traders are watching?
Immediate support is sitting in that $79 to $85 range.
Okay.
But the major long-term support, the 200-day moving average, is down at 73.95. And there's an absolute floor at $65.
And resistance going up,
The major psychological resistance is waiting up at $115.
which would be a massive breakout. And the volume kind of supports that attempt, right? I mean, recent volume spiked to nearly 49.8 million shares.
Against an average of about 37 million. So yeah, that is aggressive, convicted buying.
But the analyst ratings are kind of all over the place.
They really are. The consensus is a moderate buy. You've got 18 buy or strong buy ratings, 5 holds, and 2 sell or strong sells.
And the average target price is what, around $109.42?
Yep, which implies an upside of about 20% from where we are today.
But the recent individual actions are super mixed.
Yeah.
You have Bernstein reiterating an outperform rating with a target of $130.
Right.
But then Truist just lowered their target to 100, even though they kept a buy rating. And Barclays outright lowered their target to $89 with an overweight rating.
Yeah, Barclays pricing it basically below where it's trading right now.
Here's where it gets really interesting to me. Technical sentiment on the charts is 90% bullish.
Yeah.
But the overall market fear and greed index is dead centered at 50. It is perfectly neutral.
Yeah.
So if the chart is literally screaming buy and the volume is surging to 50 million shares, why are major players like Barclays lowering their targets below the current price?
Because it's a balanced tug of war between momentum and caution. The stock can exhibit massive short-term strength, pushing that RSI near 70.
Right.
But long-term analysts are looking at the macro environment.
Yeah.
They are wary of market overextension. They see that 44 multiple, and they know it requires perfection to maintain.
Well, let's talk about what happens if they aren't perfect. Let's move from the chart momentum to the fundamental threats. What does the worst-case continuation lower look like, and why do retail traders so often get trapped in these setups?
It comes down to structural risks in their actual business model, the biggest one being regulatory risk.
You're talking about payment for order flow.
Exactly. PFOF. Continued regulatory scrutiny on payment for order flow remains a core structural threat to how Robinhood makes its money.
Because if regulators ban or cap PFOF, their whole zero-commission revenue engine seizes up.
Completely. And you combine that regulatory threat with a market slowdown. The early 2026 data shows signs of decreased trading volumes in equities compared to those peak pandemic periods.
So what does this all mean for the everyday trader? I kind of look at it like they built this massive $4.5 billion revenue skyscraper.
Right.
But it's built entirely on a foundation of payment for order flow that the city, being the regulators, might just rezone or condemn at literally any moment.
If we connect this to the bigger picture, the downside risk is catastrophic for the current valuation. If PFOF is heavily restricted and that equity volume continues to naturally slow down,
Then that high PE multiple converts.
depresses violently. A 44 PE drops to a 15 PE overnight.
Wow.
And that leads to a worst-case scenario where those support levels we talked about, the $79 level, the $73 level, they just break. And it traps late-arriving retail traders who bought the RSI momentum, trapping them in a falling trend.
That is the definition of a value trap right there. But okay, let's play devil's advocate, because despite all those regulatory dog clouds, there are some massive structural tailwinds pushing the bull narrative forward right now.
Oh, absolutely. The bull case is incredibly strong right now.
Starting with a huge regulatory win just a few days ago. The end of the PDT, the pattern day trader rule, on April 14th.
That was a monumental shift.
I mean, for people who don't know, the PDT rule required you to have 25 grand in your account if you wanted to day trade more than 3 times a week.
Which completely bottlenecked Robinhood's core demographic.
Exactly. It's like, imagine finally taking the training wheels off millions of bicycles, all at exactly the same time. That is the kind of massive volume injection that lifting the PDT rule provides. But is that alone enough to power through that $115 resistance level?
By itself. Maybe not. But it's not happening in a vacuum. You pair that frictionless retail trading with their crypto and tech expansions.
Right.
They are projecting a 10% top-line growth in 2026, fueled largely by favorable crypto regulations.
Plus, they have entirely new revenue streams coming online, like the prediction markets.
Yes, event contracts.
Yeah.
And they're using AI to drive massive operational efficiencies, which lowers their overhead and pumps up that 42% profit margin even higher.
So the long-term vision they're selling to Wall Street is this transition into a true financial super app.
Exactly. The ultimate best-case recovery scenario is that they successfully diversify away from just being a stockbroker. If the super app model works, it completely justifies the high multiple and could potentially drive the stock toward those massive long-term projections.
Okay, so let's summarize the timeline for the listener. Short term, say the next few days or weeks.
Short term, you want to watch for a potential retest of that $79 to $85 support range.
And if that floor holds?
If it holds, expect to climb back up toward that $100 psychological mark.
Got it. And long term, we're talking 2026 through 2030.
Long term, analysts are targeting between $125 to $130 by year-end 2026. And 2030 projections, some are reaching as high as $191.
But the immediate catalyst, the thing that is going to dictate the next major trend direction, is coming up incredibly fast.
Right.
The Q1 2026 earnings calls on April 28th, 2026. That is going to be huge. We're finally going to see the actual numbers on how the PDT rule removal impacted their volume.
But this raises an important question. What happens when a platform that is attempting to become a financial super app suddenly faces a massive systemic market correction before it is fully diversified away from its core trading revenues?
Man, that is the terrifying part of the transition phase. If macro conditions tank before the super app is finished, the whole thing could wobble.
Exactly.
Well, we've given you a ton to think about today, and actually, I have a question for you listening. Would you like to see a direct comparison of Robinhood's PE ratio against traditional competitors like Charles Schwab or Interactive Brokers in a future deep dive? Let us know in the comments.
That would be a really eye-opening comparison to run through.
For sure. So thank you so much for joining this deep dive. One final reminder, we are just analyzing the data. This was not financial advice. Stay sharp out there in the markets, and we'll catch you on the next one.